We're going to be focusing on success stories with the opportunity to discuss with some successful CEOs about their particular experiences. And I'm going to start with Philip Odosa, the Group Managing Director and CEA of UBA Bank. And I'd like to ask you, hello? We're starting. Thank you. I'm going to ask you to share your secrets of success, what investment opportunities exist within your company, and outline how investors can participate successfully in your company's growth. So again, here we're talking about partnership, the compelling growth and opportunities in Africa. How do we do that with UBA Bank?
Thank you so much. My name is Phillips Odoza. I'm the Group CEO of UBA PLC, United Bank for Africa PLC. UBA is a very large financial services institution that operates in multiple markets. It has the head office in Nigeria and operates in another 18 African countries that cut across from West Africa to Central Africa, to East Africa, and then part of South Africa, essentially Zambia and Mozambique, and so on. Now, the fact that UBA operates in multiple jurisdictions and markets gives us opportunity to tap into the key drivers of the various economies. And the success of UBA lies essentially on the fact that UBA plays in the key emerging sectors. For instance, in the case of Nigeria and a lot of the African countries, UBA is a very strong player in infrastructure. It's a very strong player in the area of power, very strong player in agriculture, very strong player in oil and gas upstream, and a very strong player in the area of power and telecommunications as well. So all these areas enable UBA to earn some form of premium income and fees, and that is what is largely responsible for the success of UBA. Now, in terms of how the opportunities and how investors can benefit from the growth of UBA, you find out that UBA has very diversified sources of earnings and revenues. Today, 20% of the revenues come from Africa, and 80% Africa outside Nigeria, and then 80% from Nigeria. The objective in the medium to long term is to balance it as 50% coming from Nigeria and 50% coming from the other diversified economies of Africa. And the implication is that the earnings are more or less diversified, and you don't have the concentration risk of one particular country or economy. The second one is the fact that UBA can be seen by investors as the face of banking in Africa. If any particular investor wants to enter into Africa, you can actually partner with UBA because UBA understands the terrain very well, and being a bank that operates in each of these countries can actually guide you to enter into the market. The third one is that somehow the market has not been able to price the stock, the share price of UBA, in accordance with the expected income. And to that extent, you see the stock trading at about 1.3 price to book. And it is a very good buy for any person that wants to benefit from the income coming from the various African countries and so on. So this is, the value proposition for anybody that wants significant income for the future. Thank you so much.
Well, you see again, a partnership strategy entry. Now we're going to go to Jean-Louis Acre, President of the African Export-Import Bank, with the exact same question.
Okay.
Thank you.
although we are not competing, thank you, Barbara. Our bank is a leader in trade finance in Africa. We are the only trade finance bank that has a multilateral status and preferred creditor status in 34 African countries. Although a multilateral development bank, we operate as a profit-oriented institution. We have consistently paid dividends to our shareholders since 1997. We have a unique positioning. Our bank, through our bank, you can access 34 African countries, as I said, through experienced staff with a long continuity, a long experience in trade finance, staff coming from 10 African countries, all gathered either at our headquarters in Cairo or in Abuja and Harare. Our loan book is mainly short-term and secured, and have self-liquidating trade finance structures with the majority of loan repayment risk usually transferred to OECD countries. That's what explains a gross NPL ratio of less than 1%. The bank has a solid credit profile, BBB minus rated by S&P and Fitch, BBB by Moody's, a payout ratio larger than 20%, return on average equity of about 11.5%. Our total assets is around $3.7 billion US. When the bank was being established in 1993, total African trade was around $200 billion US. In 2011, total African trade passed the 1 trillion mark. That's why the bank has undertaken an initiative to increase its capital. And to increase our capital, we have created a new class of shares, which is essentially targeted at attracting institutional investors, equity funds, etc. It is a class that in the next 2 to 3 years, we intend to put on the S1 stock market. So you are talking about an institution with a preferred creditor status and an institution that can also pay high return on your investments. That is the bank that we are presenting to you today. Thank you very much.
I think the point that is really important as we look for avenues is how do we make sure we use the DFI, the multilaterals, especially those with investment grade status, which is important for many of the investors in the developed world. So that's very welcome. Now we go to Albert Eisen, Deputy Group CEO of EcoBank.
Thank you very much. The EcoBank Group is a full-scale service banking institution. So we cover the commercial, the retail sector, and also investment banking. And we have the largest footprint in Middle Africa. We are in 34 countries, headquartered in Togo, and we also have offices outside Africa, which is basically Africa-centric. We have an operations in Paris, a rep office in Dubai, London, and China. And we have total assets of 20 billion plus, about 19,000 employees, and 1,200 outlets. Now, what is the success, the secret of our success? And I can put it on three main issues. That is focus on our coverage area. That is our ambition to build a first-class Pan-African bank, and also ruthless execution in building an African banking champion. Now, focus on Middle Africa. We chose Middle Africa, and that makes us successful because we thought that Middle Africa has all the resources. It's growing very fast. It has a big market, about 900 million potential customers, and also presents a very good return on investment. So you'd realize that we cover West, East, Central, and parts of Southern Africa. And we cover the Anglophone, the Francophone, and the Lusophone countries. Okay? And we are quite integrated in that sense. Now, our ambition to build a Pan-African bank, first-class one, is because we believe in scale, diversification, growth, and efficiency. And we know that growth is critical to maintain a leading position over the industry. Scale is important for competitiveness. Efficiency is critical for economies of scale. And we believe in diversification, which is important to absorb shocks in a cyclical industry, such as banking, and especially in our coverage area, which is Middle Africa. So we always ensure that we would give a return to the shareholders. We are profitable, and we've been paying dividends for quite a long time. Now, execution has also been one of our hallmarks. And we've had three phases of execution. The first was the formative years, that is 1988 to 2001, when we largely built the platform in West Africa. Then from 2001 to 2011, we call it the expansion phase. That is when we moved the bank to Central Africa, East Africa, and southern part of Africa, and also the international cluster, we call it. Now we are focused more on optimizing the network and platform by generating good returns to the shareholder, becoming an employer of choice, and finally providing very good customer services to our clients. So this is who we are. We have the largest footprint. I think UBA talked of 18. We have 34. The latest one is Southern Sudan. And we hope to have perhaps one more before the end of the year. Thank you very much.
So you see, we have a big footprint here at the table. What questions, which comments? We have a few minutes. Do we have some comments? Some questions? For example, today our political leadership asked about infrastructure finance. We talked a lot about pension funds. We talked about stock markets. Do you see the potential for your institutions to really address these issues? And if so, how would the constellation of partnership work here? Who would you involve from this room, and what instruments or approaches would help you deal with both domestic and the larger regional infrastructure projects? Is that an okay question? Oh, and we have another one. Let's take another one here. Please identify yourself.
Okay, thanks. Melissa Cook from African Sunrise Partners, and I've had the chance to ask some of you individually this question, but I'm interested in how Africa's capital is going to be mobilized better. As you all know, it's more profitable for banks just to buy treasury bonds instead of lending into the real economy. How is that going to change? What are the drivers of that change to get more capital out there into the real economy? Thank you.
You know, it's
Go ahead.
As if you heard the conversation that I was just having with Minister Aganga just before he came to speak here. If you look at most African markets, you're right. Government issue bonds, and if they issue bonds at rates that are above 10 or 12%, what's the incentive for a commercial bank to take deposits and go and take risk on customers where the price or the return is not going to be commensurate to what you have with government? So there is something to be done there, particularly in some cases where it is its own money that government eventually is borrowing there. There is a need for policy in that regard. But more generally, the commercial banks needs to know how to structure better transaction in order to remove certain risk perception that are there. Our own experience is that Africa is not as risky as the risk premium is saying. We take our own example. We were able to achieve, on average, a non-performing loan ratio of less than 1%. So if we were able to do that, it means that it is possible to do so. We have lent our credit to an issuer in Zimbabwe for it to issue a bond of the initial amount was about $50 million, and it was oversubscribed to $125 million. But it was backed by our credit. But yet the issuer has been able to perform throughout the tenor of the bond. So the message I want to give here is twofold. One, a policy response to what you just said, and two, the capacity of commercial banks to structure better transaction in order to attract private investors or those who are looking for higher returns. Yeah.
Let me add to that, and I guess the CEO of Afrexim, talked about policy issues, and I want to say that is very, very critical, to support the infrastructure. If you take, for instance, the case of Nigeria, where the pension fund is very, very significant, I believe that there must be a way to channel such liquidity into funding of critical infrastructures, because generally, for the commercial banks, you find out that their sources of funding are usually very short-term in nature, and it becomes an issue of mismatch if you are channeling some short-term funds into long-term assets. Absolutely. So there must be some form of review of the policies that will enable some long-term funds to be made available for financing long-term assets. The second one is the fact that critical infrastructures across Africa, whether we are talking of agriculture infrastructure, or we are talking of transport infrastructure, or we are talking of power, and so on, need to be financed. And the banks are in Africa have started applying their balance sheets towards financing of the infrastructures. A typical example is in Nigeria, where we have recently, concluded a very transparent privatization exercise of the power sector, both the generation sector and the distribution. Now, Nigerian banks actually funded significant portion of the acquisition of these assets by the private sector. And the reason is because the banks actually believe that the private sector will be able to drive a lot of value, from these assets and so on. And I want to state that UBA categorically in Nigeria financed to the extent of about $700 million in the privatization scheme. And I also want to state that during the recent visit of President Obama to Africa, where some CEOs met with him, about 10 to 15 CEOs that operate or have business across Africa. I did comment in that meeting, the roundtable meeting, that UBA is dedicating as much as about $2 billion towards financing of power infrastructure in Africa, of which about $1.2 billion will be dedicated to Nigeria, and the other $800 million across the rest of Africa that we need to finance the power. So you find that gradually the banks have started, moving into the areas of real sector. Also, recently, one of the biggest transactions that have to do with petrochemicals, refinery, and fertilizer plant, which are a fundraising program, was done for Dangote Group. Unfortunately, Aliko is not here. It's a $9 billion transaction. And I want to state that Nigerian banks as a whole committed as much as about $3.3 billion towards that particular program. And that is very substantial. So gradually, we are seeing a shift from financing government securities, even though they are more attractive than the real sector, going into the real sector, because we believe that ultimately the cash flow from the real sector will be quite stable, and especially if there are some long-term projects that are being financed and through the model of PPP. So gradually we are going to see that happening. And I want to state that UBA is at the forefront of financing critical infrastructures across Africa. Thank you so much.
Yeah, let me add here, as Philip said, you need to have very strong banks to be able to play the role that he just mentioned. Okay, and you realize that after the reforms of the banking sector in Nigeria, you have quite well adequately capitalized banks to do so. And I think that the regulators in other jurisdictions need to follow that so that you have very strong banks, adequately capitalized banks to really play in the real sector. Policy is important, but where you also have adequately capitalized banks and strong banks, they are able to play that role. So scale is extremely important in our type of business. Thank you.
You can see that we have really active bankers, but this panel wouldn't be complete without a CEO that's a woman and also extends beyond finance to the other sectors of the economy. So if I could welcome Savannah Maia, is that how you say it? Maia? Mazia, I'm really bad. CEO of Baningi Holdings, and ask you what you would offer as success, what you think are the critical success variables that have enabled you to do what you have done, and how others can participate and partner with your company and others like you in Africa.
Thanks, Barbara. I appreciate it, and sorry we had a bit of a traffic situation downtown. We are in the space of developing projects in the mining and infrastructure space throughout Africa. So we will build ports and roads and railways, and we'll also develop mines. I think we've been doing this for the past 15 years now, and we're largely a women-owned group, which is quite rare in our part of the world. What we are finding more and more is, as I was just listening to the gentleman talking, even though I came in a little bit late, that we are finding banks are much more and more open to investing in the kind of projects that we develop. We're also finding that even construction companies are very willing to work with us in taking equity in our projects. And we're also finding that we're fighting between the West and the East to be able to get funders who are very, very keen to come into the continent on projects that have really been fully developed, that have an income stream for a very long time. So we're not struggling, I don't believe, to get funding for good projects. But the issue is that they have to be good, they have to be sustainable, and they have to be able to deliver attractive ROIs for any investor that's coming into the market. We're also moving away from the position that just because a project is in the continent, people should see much more returns than they see elsewhere. I think one of the things that we're looking to say is we're looking for good returns, but they must be commiserate with what's happening internationally and not have Africa give such amazing returns that are not necessarily seen elsewhere. Because one of the things that we're saying is that we're trying to ensure that we're using local labor, we're trying to ensure that we are upskilling our own people so that projects are not expensive, they are at the same cost as everywhere else, and the risk is minimized, as opposed to saying you're paying a whole lot to be able to get good returns because the risk is so high. Our job is really to minimize that risk so that the job, be wherever it is in the world, would be similar to other jobs in the world, because it's important that we really play the role of de-risking projects. So we found that that's really worked very, very well for ourselves.
We've come to what is supposed to be the end of the panel, but maybe there is one more or two quick questions, or if not, perhaps people can speak after the panel. Any questions? Here, we have a question back here. Please identify yourself.
Hello. Hi, Tim Sebunya, Mutima Capital. Question broadly for the panel. Seems like you're all in multiple countries. How do you think about currency risk in the various countries and how that impacts your returns today? And as importantly, how you see currency risk changing or currency management changing going forward? Thank you.
That's a great question. Why aren't you jumping?
Yep.
I think it's
I think that it depends on where you find yourself in terms of jurisdiction. When you take the Francophone West and Central Africa, that is the UEMOA and the CEMAC areas, you tend not to have, that is, if you deal within that zone, you tend not to have a currency risk.
Yeah.
They all use the CFA, either the ZAF or the ZOV, okay, depending on where you find yourself. Okay, the ZOV is in West Africa, the ZAF is in Central Africa. Yeah, so that is not a problem. Now, when you deal with the Anglophones, then that is where you need to watch out for currency risk. As a rule, we would not, except it's a real exception, we would not want to take a cross-currency risk. It's quite difficult sometimes to buy that insurance for the cross-currency risk. So we would want to match currencies when we do so, except when you step into an international currency like the dollar. And you want to make sure that either it's euros or dollars, whoever the obligor is will be able to pay you back. If even it's a cross-border transaction, you want to make sure that you're going to get the same currency back. You know, our part of the world is quite volatile with regard to currencies. So in as much as possible, you would want to minimize any cross-currency exposure. But in the Anglophones, the ZAF or the ZOV areas, you can easily trade across those clusters without much of a problem. So
Okay,
that is what we do.
Okay, thank you so much. Just to add to what Mr. Essien just said, the same thing applies to UBA that operates in different currency zones. And basically, when you have a big ticket in any of these zones, whether it's the CEMAC zone or the UMOA zone, what you see is a pooling of funds by the various countries in that particular zone to fund such a big ticket. And the implication is that you don't have any currency exposure in these locations. Now, when it comes to the other countries that don't have common currency, where transactions are done, we actually go with some form of hedge to hedge against the currency, risks and exposures and so on. So that's basically, what we do. But increasingly, I believe that as some of these markets evolve, we also need to come up with better strategies to deal with that particular risk, because it is actually real. And when you look at the commodity countries, because of the volatility that you have associated with the commodities, that risk actually exists. So either we do a hedge for them, or we actually avoid such risks, and so on. Thank you.
Savannah, did you want to make a comment?
Yeah, I do. As an operator, our projects tend to be from the 30-year to the 50-year space. And so we took a decision when we began the business that, with our bankers, that all our projects would be dollarized. So from the get-go, whatever, it doesn't matter what country we're in, the fact that we've got a contract for 30 to 50 years in that country, we just use dollars. And even if it's for payment of our staff there, it's for delivery of product, everything is costed in the dollar environment, and returns are in the dollar environment. So salaries then are pegged at the dollar, even if they may be paid in local currency. But everything to do with the project is dollarized.
I think the fact that there is the market for foreign exchange is not very deep. It's better, like Albert was saying, to match asset and liability. You raise deposits in this particular currency, in this particular country, and you cover it. There is no real forward cover market for cross-currency. If you want to cover a city against Naira, you're wasting your time, because there's just no market for that. The best way, the best bet for you is to do to raise liability in this particular currency and match it with the particular asset that you want to fund. It's not easy, but that's the best way to do it.
Okay. We want to avoid another Asian financial crisis with mismatching currencies. We're going to can you make it really short? Okay. Please, can we have a mic over here? Very quickly. Okay, if you can bellow out.
Well, I was listening to President Museveni, and it's interesting because that argument would never go away. I think people forget that banks also operate in an economy. So banks take a cue from what governments do. And I'm Ghanaian, and so I can be politically correct if my ministers are here. When rates, the government did not crowd the private sector, okay, and rates went down in Ghana, we had single-digit interest rates. When the rates go up because they choose to get into the market to buy, rates go up. A depositor who would go to the government and place a treasury bill or bond for 15% would never want to give the money to the bank for 3%. Now, if I am to compete with that same depositor, then I also owe it a duty to my shareholders to make some money on what I do. Clearly, I will take a cue from government or from the central bank. If the monetary policy rate is 15%, sometimes we even lend below that, depending on the type of risk, but clearly it's a cue for you to do riskless rate plus a spread. So I think that it behoves on both of us to work together jointly. And this issue of blaming the commercial banking sector will not resolve it.
Yeah.
I've been very clear about that. It won't resolve it, okay? There's nothing like a Father Christmas because the shareholders want their return. So that's my answer. You know, he was here, so you have to be polite to president. So you allow him his due. But the fact of the matter is, it's a joint journey.
In fact,
It's a joint journey.
in fact, I want to confirm that it is not a joint. It has to start with government first.
I was more polite, isn't it?
What do we do? No, but it is factual. What do we do ourselves? We've been able with our rating, our investment grade rating, for the first time to raise 5-year money below 4% on the international market. Below 4%. It has not happened. You can hear about bonds that are issued, 7%, 6 point whatever. In May this year, we raised a bond at 396 coupon. Our intention is to continue that way. Our intention is to use instruments like backed by AAA, ADB type. ADB borrows even below at below LIBOR. So if you can use this, these are the kind of money that you can use to fund the so-called infrastructure projects which we have been watching in the movies for many years. Yeah. It's not so difficult to structure them in such a way that you can mitigate most of the risk and package it and sell it to investors who want good return. Look, power is going to be paid. And if it's not today, it will be tomorrow. If you find a system to remove the credit risk from distribution of power, commercialization of power, the same way you have mitigated the risk on the mobile phone. Today, people, whether you use your mobile phone or not, in most African countries, you have paid for it. And if you don't use it quickly, it expires. So it is liquidity, and there is no risk, actually, for the mobile phone operator. So if you move on that same vein for power, and they are now more and more doing prepaid meters, I think that may be an answer. And then we could do all kinds of power projects you want in Africa.
I'm going to close it out, but if I take, you wanted to say something quickly?
Yes.
Okay. Okay.
Just to add, just the last one. And I think it is very, very good for the people that operate from the public sector to hear this, because one of the mistakes that some governments make is to go and legislate interest rates.
Yeah.
You just can't legislate it, because when you do that, apparently what you have is market failure, because the banks don't lend anymore, and every person just keeps his money, and so on. So for the interest rates to come down, every person must join hands together. The critical infrastructures must be in place, because if you are paying for generators to generate power, it then means you have to pass that cost to somebody. And that is what happens when you do your lending and so on. So everybody needs to come together to work towards bringing down the interest rates. Thank you so much.
Very important, but we have to challenge ourselves to keep this conversation going. Again, if you look at the African Development Bank study, they are on risk mitigation. This is an ongoing dialogue. In Uganda, for example, the Bank of Uganda has subsidized interest rates at 12%. There's a lot of on-lending facilities, as you know, that your own banks may be involved in with lower interest rates. So there are a lot of mechanisms out there, but they're not used. That's what's so ironic. So we got to keep pushing on this front. Please join me for thanking this really important panel and saying how we're going to address some of these issues and partner with them. Thank you.
To doing business in Africa. You can't afford to be without Africa Investor.